We're back, and Harry wants to challenge the naysayers who say he's always negative. Harry, I've followed you since I heard you, I don't know, in the 2000s when you were overly positive, early in the 90s with the
when people
tech
thought
boom.
I was the craziest, when I said in the early 90s at the bottom of that recession that the Dow would be 10,000 by 2000, and people thought I was certifiably crazy. I underestimated it. It went to 12,000 something by then.
So what do you say to those who think you're always negative? I mean, I know you were positive in the 90s. What, your first book, wasn't it like it was like the boom, the great boom or something?
The great boom ahead.
Yeah. So you're not always negative.
In late 1992. I had a book before that.
Yeah.
In 1989 that was extremely bullish. So the greatest boom in history is coming, especially in the U.S. and Europe. Oh, and guess what, folks? Japan's not going to be there for it because their baby boom's already peaking in the late 80s. I was the only person I know in the world that saw Japan collapsing. And people back then, the reason they thought I was crazy for being bullish on the U.S. because they were so bullish on Japan and thought Japan was going to overtake our economy. Because they don't. What I say to these people, Josh, they don't understand the economy. They're not looking at the indicators that actually drive the economy. If you did, you would have known Japan was over back then, and the U.S. and Europe were just getting ready to see the greatest boom in history. It was already in the cards. It was a piece of cake. A 10-year-old could have figured it out if you were looking at the right indicator. Economists are not taught, nor do they look at the indicators that matter. And at the top of a boom or bubble, when everything looks perfect, like 1989 in Japan, 1929 in the U.S., or 2000, early 2000 in the tech bubble back then, the economy looks perfect. You're never going to have a reason to say there's going to be a downturn or crash. You have to be looking under the hood at the actual demographic and technology cycles that actually drive economic growth and actually peak at times and cause declines. It's that simple. It's not complicated. Economists just don't know what they're doing. That's what I say to them. You don't know what you're doing. If you think I've been negative all my career, then you haven't looked at me in the past. You're just pissed that I'm bearish when you're bullish. And you were pissed when I was bullish when you were bearish in the early 90s. So what's wrong with you is what I say.
That's great. You're always a live wire, Harry, and a lot of fun. So as it relates to the economy being sick, the economy is truly sick when you have no buyers. I think the biggest indicator of the sickness of the economy was March of last year when the Fed had to bail out bond ETFs. People do not realize that our mutual funds, our index funds, our ETFs are in a bubble. I want to talk about that, the index fund bubble. A lot of people don't really understand. They're just told. I mean, I was on a group of New York Times bestselling authors. We were with Dr. Brad Klontz, who's a big TikTok star. We're with, I was talking to a group of people, Bobby Rebell, bestselling author. And it's almost like these personal finance writers, and they're great people, they just think index funds always go up. So that's what they tell people. Buy index funds. You'll be fine. Leave it alone for 40 years. So what do you say to that?
Well, that's fine if you're in the early stage of a cycle. The truth is, and this is what my demographic cycle has shown, and have shown all the way back to the mid-'80s when I first came up with them. Economic booms generally last about 25 to 26 years up and 13 to 15 years down, okay? 1983 to 2007, then 2008 to 2022-23. It's before that, 42 to 68, the Bob Hope generation, and then the economy weakened from 69, and that's when stocks peaked, adjusted for inflation, late 68, and the economy didn't bottom till late 82, 26 years up, 14 years down. That's the truth. It depends on when you're investing in the cycle. If you're in the early stage of the cycle, you can buy and hold stocks for decades. If you're in the late stage of the cycle and somebody says that's okay, in 40 years it'll work out, well, I can tell you today, after this peak and in past peaks, it takes 23 to 25 years just to get back to even if you invest in the late stage in the cycle and decide to hold for 40 years. So you'll have 25 years down, 15 years up, and then you'll just get back to even, and you'll be long dead by then if you're near retirement. So that's not a good strategy to just say, well, in the long term, stocks generally go up, so I'll just buy and hold. You know, you have to know where you are in the cycle, and it's not complicated. Generations tell you where you are in the cycle.
Now, what about, I remember we had you on last time, although this is the type of intensity, Harry, that I wanted you and Stan at the next debate. We got to have the Stan Harley, Harry Dent debate. I want you guys to go at it and fight, but I think you guys agree more than you disagree.
Oh, yeah, we agree way
You're
more
very
than we
similar.
We're only disagreeing about short-term time.
Yeah.
He's a short-term cycle guy.
Yeah, you're more of the long-term demographic cycles. Yeah. And what happens is, I think the Fed knows we're in a bubble. And they're trying to have the soft landing. And next, here's what I'm worried about. We start going down this summer. Let's say we go down 15%, 20%. And then they come out with helicopter money. And then that saves us from the big crash for another year or two. I'm so worried about this. Like, there are now economists that say you just make up money. You just add a zero. Well, what we don't.
The solution to everything. Janet Yellen, all the Fed chairmen. Oh, we'll just print more money. Like it's genius. Oh, these people are geniuses and they're saving our economy. They're making a bubble and a debt crisis worse. And it will be worse because of this. And they don't know crap about anything. I would say that to anybody. Janet Yellen doesn't know crap about economics. And do you think she's ever had sex or run a business just for one thought? Well, why are people listening to these people? Oh, they do. We have a crisis. They just wave a magic wand, print money, and expect it to go away. Why would anybody listen to these people? And you know what people do? Because it works short term. I can guarantee you one way to feel better, Josh. I don't care how miserable you are right now. You go shoot a bag of heroin, and you'll feel like heaven for the next several hours, and then you'll come down with a big crash. This is what we're doing in the economy. We're not facilitating the transition from a booming economy to the next boom in the old technologies to the new by restructuring and incentivizing new companies and investing in new companies. We're just printing over and keeping the old sick economy that's already dead and not letting it die and get out of the way. It's bad policy. And it shows a complete, listen to what I'm saying, a complete 100% misunderstanding of the actual play of opposites, boom and bust, inflation and deflation. We don't have innovation without that play of opposites. And economists want to have a machine economy that grows at 3% with 2% inflation forever and no recessions, which means they understand nothing.
No, exactly. And also, I want to be clear here. We do not
listen to him ever again.
Yeah, I want to be clear here. We do not want to encourage the use of drugs in any way on the Financial Quarterback radio program. I'm sure you were speaking hyperbolically.
Josh, you think I'm an idiot? You think I recommend heroin? It's a perfect example, though. You can instantly feel good by doing the wrong thing, by doing something that's proven to make you unhealthy.
Yeah,
I'm saying
it's like a sugar high.
Central banks are like drug pushers in our economy. They're using financial drugs to keep our economy going in the wrong direction.
But that's my point, though. But that's my point. Can't they do that longer than we can even envision?
Done it for 12 years. Of course they can do it longer. But note, how much did they do? When I add up, that's why I started with the numbers. Since in the last year, since that repo crisis, they have printed almost $4 trillion and 5.1 in fiscal stimulus they've introduced. That is an exponential move. We might have averaged $1 trillion a year before that. Now in 1 year, they print 10 times as much stimulus. That's what it's taking. That's when you know you're near the end of a bubble, when it's that exponential, when it takes that much.
Also, if you really, this bubble is the extension of the '08 bubble yet to burst. You alluded to that earlier. The first stimulus in '08 was $900 billion.
We balanced the economy after that bubble burst, and so all we have is a bigger bubble to cover over the crisis of last time, and we didn't do anything to fix it.
Where do you see interest rates?
Have to fix it ahead, much harder and much deeper.
I have a listener question for you. Where do you see interest rates headed?
Lower for the risk-free Treasury bonds rates. I tell people right now, I'm telling people it's about time to load up on 30-year Treasury bonds, because they lock in about a 2.5% rate now, which seems really low, which it is historically, but it's very high compared to where we just saw last year, in which we're going to drop lower down to 0 to 0.5%. That bond, one of the safest investments you can have, and the one the government's going to pay off, and the one thing they'll print money if nothing else to pay off, are those bonds, and that could appreciate 40 to 50% in this crisis, while stocks crash 80% and Bitcoin crashes 95%. So the risk-free rates go down with deflation and slow economy, but all of the risk rates, corporate bonds and junk bonds, in comparison to the risk, those risks go up because the default risk skyrockets, just like they did in 2008 or any recession or depression in history. So most interest rates on bonds are going to go up. The safe place to be is in the highest quality government bonds or in AAA corporate only. I don't even want AA.
Yeah. So basically,
those go down.
Then that would also pose well, I guess, for life insurers that have a high credit quality as well.
Yes.
Or fixed annuities.
Why do you think the life insurance industry was the only part of the financial services industry that did well in the 1930s? They benefit from falling rates, and their policies require them to invest in high-quality fixed income.
Yeah.
The very safe haven, and gold is not the safe haven, and Bitcoin is not the safe haven, and people are buying both of those thinking they're going to be the safe haven. These high-quality bonds and this type of stuff insurance companies are forced to buy, that's the safe haven. That's why they're forced to buy them to back insurance policies. We can't afford to have them speculating in stocks, and then when we need our policy, oops, the market's down 50%, and we can't pay your policy.
That's a great point, Harry. We'll talk next about income inequality and how keeping rates artificially low is really hurting seniors, retirees, and the middle class. And maybe the solution is to raise interest rates over time. This is Josh Jalinski, the financial quarterback. Don't touch that dial. We're back. This is Josh Jalinski, the financial quarterback, with Harry Dent, best-selling author. And Harry, everybody complains about income inequality, but isn't the real reason for income inequality artificially low rates, which is screwing the middle class? Want to talk about that a little bit?
Yeah. Well, there's two things. On my cycles, there is what I call a fall bubble boom, which happened into the 1929 and is happening here into 2007. Those bubble booms cause financial assets, real estate, and stocks, because of falling interest rates, by the way, naturally out of inflationary summer into a fall disinflationary boom, they cause financial assets to outperform. So that causes bubbles in financial assets, and that causes income inequality, because 88% of financial assets outside of people's home is owned by the top 10%, and the top 1% owns 40% or more. So that is it. Now, when you on top of that print money to push long-term, not just short-term rates, but most importantly, long-term bonds into negative yields right now, the 10-year Treasury has gone way up. It's 1% over last year. And it's still a negative, adjusted for inflation, around 2% currently, give or take, okay? Negative yield, that pushes up financial assets. So stocks and real estate are they're artificially high now in a weak economy, when coming into 2007, they were pretty darn high valued in a good economy. Now we're in a bad economy that requires endless stimulus. And the stock market, if you looked at just the stock market, you would think we're in an economy twice as good as 1999 or 2007, that the economy is just better than ever. And yet this sick, dead economy is requiring $9 trillion in the U.S. alone just to get to next year out of the COVID crisis.
Wow. Yeah, when I say
stocks are out of whack. And yes, stocks, high financial assets, benefit the top, 1 to 20%, way over the everyday person. Most people don't have much money in stocks, and the money in real estate is typically in some not so overpriced suburb or smaller city for the average person. So they're not in New York, Manhattan with a great real estate bubble. They're not in tech stocks.
Are you still, this is a total aside, but you've talked about Puerto Rico. You You still in Puerto Rico?
I am. I tell you, people think it's hotter than Florida. It's less extreme. 69 to 92 is the temperature range here all year around. A little less rain than Florida. I am 2.5 hours from Miami direct flight, 4 hours from New York, 5 hours from Dallas. That's getting a little long, but if I go to the East Coast, it's easy. I'm saving income taxes. But you know what? My biggest surprise, I got to Puerto Rico for buying a property on Calabar, an island, 25 years ago. When I finally got a house up and they finally realized I had a house up there, which took them a long time, I get my property tax bill.
It's like $500.
It is
right?
1/20th of my property tax bill as a percent in Florida. 1/20th.
Wow.
So I'm paying low income taxes, low property taxes. The only thing I'm paying here is a 10 to 11% sales tax, and I buy half my stuff from Amazon with no tax. So I love it down here. People are nice. In the areas I live in, mostly English spoken, lower cost of living.
Yeah, all you financial
and they don't
guys.
have this blue-red war we're having in the United States. They're not going to be shooting each other when this economy goes down.
Well, yeah, I want to go to Puerto Rico. That would be fun. John Malden's down there, David McKnight, a lot of guests. All these guests.
Peter Schiff as well. I debate all those guys down
Do you guys hang out? Do you have like the Economist Club of Puerto Rico?
I spend the most time. He's my nemesis, but I spend the most time with Peter Schiff. My wife knows his wife and stuff.
He's your nemesis.
We debate the most. Peter and I both see a crisis, but he sees an inflationary outcome, and I see a deflationary. But so that makes a very
it's a very different.
Peter and I debate a lot.
I mean, I think when the garbage hits the fan, I don't see an inflationary worldview, because then you still have to go to the grocery stores. And it's like in March of 2020, Bitcoin was down to what, like 3 or 4 grand, because you still have to use cash to wait online in Costco if there's a crisis. They're still not taking Bitcoin, but I guess in the future they will take all that stuff.
Well, there's something more than that, though, Josh. Another number I throw out, and this is an important number because it was about 300 trillion before we got into the 2008 crash.
Derivatives.
525 trillion, 6.5 times global GDP of financial assets now in the world. What people don't realize, when this bubble burst, about 40 to 50% of that, and that's historically proven, that's what happened in the 29 crash, disappears forever or for a long time. That's taking money, real money in people's brokerage accounts and equity in their real estate out of the economy, and that makes people feel poor, and that causes deflation alone. A slower economy, but particularly when financial assets contract like in the 30s. See, we had recessions in the 70s, but it only brought inflation down. It was only in the 30s that we actually saw deflation in consumer prices, because financial asset prices went down so much and took so much money and stimulus out of the economy.
And we were seeing that in 2008. That's why they injected such a stimulus. We were having deflation.
Well, see, they reacted quickly. We were just going into deflation in late 2008 that's why they stepped on the gas so hard. Ben Bernanke was the Fed chairman back then. And one thing Ben Bernanke did was study the Great Depression in great depth. They still never run a business or had sex, but at least he did that. And he knew that if you go into deflation after a boom like this, you're going to be in a depression, not a recession. So that's why they stepped on the gas so hard, and ever since. They knew that this thing would be nasty.
Okay, so we'll be back after these messages with concluding thoughts. Inflation versus deflation debate up next. This is Josh Jalinski, the financial quarterback. And if you want the 27-point ultimate game plan for retirement, call us now, 888-988-JOB.
The preceding program was sponsored by the Jalinski Advisory Group.
Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and Top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jalinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jalinski.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jalinski and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation.
Advisory services offered through Wealth Quarterback LLC.